Hello guys, welcome back to my YouTube channel. It's your boy Sam G. I'm your lifestyle and personal finance guy. To my returning subscribers, thank you so much for your support. I don't take it for granted. To my new subscribers, thank you for tuning in. I hope you enjoy the content. Please leave a like, comment, and turn on the notification bell so whenever I post, you can get a notification. In today's video, I'll be talking to you about the different kinds of stocks. This is a continuation of the investing series which I started a couple of weeks ago. I'll be talking specifically in this video about the types of stocks you can buy. I'll be going over common stocks, blue chip stocks, large cap, mid cap stocks, so just stay tuned and I hope you're ready to learn. Let's get right to it. Historically, investing in the stock market has been one of the best financial pathways to financial success. As you research stocks, you're going to have people talk about them in different categories as well as different classifications. Today's video is to help talk about some of those classifications and help you gain clarity on what some of those mean and how they work. If you have any questions, please just drop it in the comments below and I'll try to get to it as best as I can. And if you have any input to add, please add that as well. And please like this video. It helps me push out the information more to people out there through the algorithm. The first kind of stocks that I'll be discussing are common and preferred stocks. Most stock that people invest in are common stock. Common stock represents partial ownership in a company with shareholders getting the right to receive a proportional share of the value of any remaining assets if the company in question gets dissolved. Theoretically, common stock gives shareholders unlimited upside potential, but they also risk losing everything if the company fails without having any assets left over. Preferred stocks work a little differently. They give shareholders a preference over common shareholders to get back a certain amount of money if the company dissolves. Preferred shareholders also have the right to receive dividend payments before common shareholders do. The net result is that preferred stock as an investment often closely resembles fixed income investment bond than regular common stock, so to speak. Often a company will only offer common stock, and this makes sense because that's often what people are looking to buy. In this case, shareholders are looking to buy. The next type of stocks are large cap, mid cap, and small cap stocks. Stocks also get categorized by the total worth of their shares, which is also called market capitalization. Companies with the biggest market capitalizations are referred to as large cap stock companies, with mid cap and small cap being successively smaller companies. There's really no precise line that really separates each company or each category from each other. However, one often used rule is that stocks with a cap of 10 billion or more are treated as large stock caps. Stock market caps falling between 2 billion and 10 billion are often referred to as mid-sized caps, and also stocks that are falling below 2 billion are referred to as small caps. And I would like to clarify that when I say stocks that are less than 2 billion, what I'm really referring to are the market caps. So stocks and market caps that are less than 2 billion are referred to as small caps. And also stocks that are between 2 billion and 10 billion, like I said earlier, are mid-sized caps, and stocks that are greater than 10 billion, which is the market caps are greater than 10 billion, are referred to as large caps. Large cap stocks are typically considered as safer investments and conservative. Mid-size and small cap stocks are typically seen as having potential for future growth, but are a bit riskier. However, just because two companies might fall in the same category here as investments doesn't mean that they have anything in common with future trajectories in terms of growth, in terms of revenue. There's no correlation there. It's also a classification based on what their market cap is. So I just want you to be well aware of that when you're researching your stocks. The next kind of stocks are domestic and international stocks. You can categorize stocks based on where the companies are located. For purposes of distinguishing US stocks from international stocks, most investors look for the official headquarters of the company that they're looking to invest in. However, it's important to recognize that a stock's geographical location doesn't necessarily correlate to where a company gets its sales from. Especially with large multinational corporations, it can be hard to tell from business operations and financial metrics whether a company is truly domestic or international. The next kind of stock you should definitely take note of are growth and value stock. Another categorization method distinguishes between two popular investment methods. Growth investors tend to look for companies that are seeing their sales and profits rise quickly. Value investors look for companies whose shares are inexpensive, whether relative to their peers or to their own past stock price. Growth stocks tend to have higher risk levels, but the potential returns can be extremely attractive. Successful growth stocks have businesses that tap into strong and rising demand on customers, especially in connection with long-term trends throughout society that supports the use of their products and services. Competition, however, can be very fierce, and if a rival disrupts a growth stock's business, it can quickly fall out of favor with the rest of customers. Sometimes even having a growth slow down is enough to have prices dip sharply, as investors may fear the long-term growth potential may be waning. Value stocks, on the other hand, are seen as being more conservative investments. They're often mature, well-known companies that have grown into industry leaders and therefore do not have much room to expand further. Yet, with reliable business models that have stood the test of time, they can be good choices for people seeking more price stability, while still getting some of the positives of exposure to stocks. The last kind of stock I'll be talking about in today's video are that of initial public offering stocks. IPO stocks are stocks that have recently gone public through what's called an initial public offering. IPOs often generate excitement among investors who are looking to get on the floor of a promising business concept. But they can also be volatile, especially when there's disagreement within the investment community about their prospects for growth and profit. A stock generally retains its status as an IPO stock for at least a year, and for as long as 2 to 4 years after it becomes public. That's it for today's video, guys. I appreciate you tuning in once again. If you have any questions, comments, concerns, please drop it in the comment section below. And please leave a like, please leave a comment if you have any input that you think would be beneficial to any starting investors. Please comment below. I have more content on investing coming, so please stay tuned. I have a lot coming, but I think it's important to first start the education session on what the stocks are so people can kind of have clarity on what to get themselves into. I'll be having these same sessions for bonds, mutual funds. I'll be having this session for everything money. So please just stay tuned and please just continue to support as best as you can. Again, my name is Sam G. I'm your personal finance and your lifestyle guy. And I will catch you in the next video. Take care.